Welcome, my dear students, in our course International Banks, lecture number 4. Today, we're still in chapter number 1, Understanding the Banks, and we will present the last topic in this chapter. So, the first, when we compare between traditional banks and modern banks or modern banking. In this case, traditional banks operate traditional banking services like accepting deposits and offering or providing loans. This is the traditional service for any bank. What about the net interest or the profit for traditional banks? Profit source from the net interest margin with what about the gap between interest rate on loans minus interest rate on deposits. This is the net interest margin for the traditional banks. In general, when we talk about banks aim to maximize interest margins as the gap between the interest rate on loans minus interest rate on deposits. In this case, maybe banks control or limit operating costs like salaries and wages and other costs to boost the profits or to increase profits. In this case, we compare between two important dates, before 1990 and what about after 1990. Before 1990, we talk about many banking markets are closed or restricted due to the higher level of regulations. Regulated, and in this case we talk about limited competition. What about after 1990? After 1990, namely since 1992, when we talk about European Union, for example, in this case, the EU launched a formal definition of constituted banking business through universal banking model. So we can say that since 1992 or in general after 1990, the regulation level for banks will be or transformed into moderate level of regulations. And in this case, the competition level increased. So, what are the main factors? What are the main factors that transform traditional banks into modern banks? Factor number 1, as we explained in the last slide, deregulations of bank activities. Deregulations equal the world financial system adapt moderate regulations for banks. In this case, when there is a deregulation in banks' activities, the competition degree increased and open new markets. The role of state-owned banks in Europe. Mainly in this case, we talk about the privatization. Privatization in banks equal when the ownership transferred from state-owned banks into shareholder banks. State-owned banks into shareholder. In general, privatization, in general, for any firm, for any corporate, when the ownership transfers from the state-owned organization to private organization. The factor number 3, help banks or traditional banks to adapt modern banks, which is the progress in communication and technology. In this case, we talk about decreasing in transaction costs, offering new banking services. Like today, you can access to your mobile, to your account or to your bank account from your mobile. But before 30 years, maybe this is a dream. You should go to the branch and make your transaction. What about modern banks? Modern banks adapt new services or operate new banking services like Punctuals are the French term. So in this case, we talk about punctuals as a good example for modern banking services. We can define punctuals or all finance as when the bank provides banking services plus insurance services. And it's clear now what about punctuance models when we talk about conglomerates and distribution aliens. Like in this, the first model, merger and acquisition, maybe by holding, maybe by integrated model or subsidiaries for insurance. The second model, when we talk about distribution, in this case, there is distribution or focus on distribution process like distribution agreement, maybe joint, maybe pure distributors. So in this case, we talk about punctuance models as a modern services provided by as a modern service provided by modern banks. Last, last we can compare between traditional and modern banks. So the first item when we talk about products, in case of traditional limited to accepting deposits and offering loans. In modern banks, we talk about unlimited, so we can add new services like insurance as we presented in insurance services. Income sources in traditional, the gap between interest rate on loans minus interest rate on deposits. In modern, yes, the same. We can use the gap between interest rate, but plus fees and commission from modern banks like insurance or modern services. What about competition degree? Competition degree in traditional banks restricted because highest regulations. But in case of modern banks, in this case, we talk about a high competition degree because moderate regulation levels. So, in general, we can define modern banks as full service financial firms, full service financial corporation. Some banks in general have even dropped the word bank from their name and their marketing campaign, such as Berkeley's. Strategic goals. For strategic goals in traditional banks, okay, we need to expand in our assets, in our branches, in growth. But in modern banks, we focus on how you can maximize the value for shareholders. The value for shareholders. Orientation in this case, we talk about priority. So in traditional banks, the orientation supply side, but in case of modern banks, we talk about demand side. Types of banks. Number one, when we talk about retail or personal banking. Retail or personal banks, when we talk about the first, commercial banks. Commercial banks are the type of retail or personal. In general, commercial banks popular in all countries. So, commercial banks provide credit for individuals, for firms, and many commercial banks recently adapt the modern bank model, not traditional. So this is the top 10 commercial banks by Tier 1 capital in 2020. So the first rank or the first bank when we talk about industrial and the commercial bank of China, the tier 1 capital equal 380 billion of dollars, 380 billion of dollars. And in this case, the total assets for industrial and commercial bank of China equal 4.3 billion of dollars. 4.3 billion of dollars. So in this case, loans to asset ratio equal around 60% or 59.1%. We can know that bank number 1 and bank number 2 and number 3 and number 4 in the world made in China, Chinese banks. Another note that from bank number 5 to bank number 8 we talk about made in USA in the top 10 banks or top 10 commercial banks. What about your own capital ratio? In this case, we reassess the assets by using the weighted risk. So, Tier 1 capital ratio equals core capital divided risk weighted assets times 100 to get percent, like our problem. Suppose ICBC Bank holds 8 million in core capital and lends out 20 million to BMW. So this is the core capital 8, and what about assets 20 for BM? So this is the market value before risk, but the outstanding loan comes with risk weighted of 80%. So we need to reassess the loan with this weighting or this weighted 80%. So risk-weighted assets equal market value with 20 millions times the weighted risk 80 millions equals 16 million. Tier 1 capital in this case, the core capital was 8 divided 16 times 100 equal 50%. This ratio or this variable or this indicator good or bad? So it's based on what about the benchmark? The benchmark in our case, Basel 3. The Basel history, Basel 1, Basel 2, and now Basel 3. Basel regulate all the banks by set rules related to liquidity, reserves, and so on. So with Basel 3, the minimum Tier 1 capital is 6%. This is the minimum. So in this case, 50% good news and good indicator for this case. The next, when we talk about saving banks, the second type of retail saving banks. Similar in many characteristics of the commercial banks, but mainly when we talk about the difference in ownership features. So maybe the ownership due to the public in case of Egypt for post mail institution. This case talk about saving banks, but indifferent in this case. When we talk about the what about the segment or the target of saving banks? In this case, the saving banks target very small depositors. The saving banks target very small depositors. So in this case, we talk about saving or different category of segments like another institutions, and this type of saving banks very popular in some countries like Germany. More than 50% of retail banking market we can classify it as the saving banks. Cooperative banks, in this case, talk about the same with saving banks, but cooperative banks owned by their customers or members and follow the cooperative principle, which is one member equal one vote, without or regardless the share of for this member to the capital or the fund. The cooperative banks solve many problems and important factor in many categories or many sectors like housing in Europe and in USA. The mutual ownership offered retail and small business banking services may be for members and non-members in cooperative banks. In building societies, we're still in the retail or personal banking. So in this case, the mutual institution most account holders or mortgage are members in the certain rights and voting. The same we use the cooperative principle, one person or one member equal one vote. So in this case, the building society had a board of directors to manage the activities for the institution. What about when we compare between building societies and banks? Unlike banks, societies are not driven by external shareholder pressure. So, in general, for any bank, there is a pressure from the shareholder to maximize profit or dividends. So, in this case, no pressure from the shareholder. So, in this case, the building societies run on lower costs and offer cheap loans and services. But there is a restriction. There is a restriction, which is what about the ability to raise the funds? In this case, the maximum percent, 50% to increase the fund from the wholesale market. In case of retail, we still in credit unions. Credit unions is the same non-profit cooperative institution. So in this case, we talk about the services closed to the members. The services closed to the members. Say, suppose you want loan from credit union. The first question, are you a member or not? If you are a member in the credit union, okay, in this case, no problem to get a loan and accept it. But if you are not a member in the credit union, in this case, we talk about rejected case for this problem. What about the facts of credit unions in the year 2019? For example, the loans equal 1.8 trillion of dollars, assets 2.6 trillion of dollars, and in this case we talk about a very important rule for credit union to fund activities for the members, and as we presented, credit union closed to members. So now there are around in the world by the year or according to the year 2019 there are 86,055 credit union around the world from 118 countries. 118 countries serving 291.4 million of members. The last type in retail, we want to talk about finance house. Finance house, in this case, supply finance to individuals and firms. So, by offering consumer and commercial and loans, kinds of loans. So, in this case, there is a difference between finance house and banks. So, unlike banks, they don't receive deposits but raise funds by issuing money market such as commercial paper and capital market like stocks and bonds. All major retail corporations and motor companies have their own finance, like General Motors. General Motors had own finance to fund the car purchases for clients. The business credit finance house use factoring and purchasing accounts receivable and leasing finance business. So in this case, suppose I have a commercial paper with nominal value 1,000 of Egyptian pound. But the payment or the maturity due to the after 3 months. I can liquid this commercial paper now by go to finance house. So the finance house liquid my commercial paper with deduct the percent as the commission, maybe 20%. Private banking. Private banking in this case target high quality or high rich individuals. High rich individuals. So private banks worldwide like Bank of America, Morgan, HSBC, JP Morgan, and another. So it depends on the concept of high net worth individuals. High net worth individuals, which is defined as investors with 1 million or more in investable assets. So this is the pyramid for the private banking. This is the pyramid for private banking. The mass affluent start from 100,000 of dollars to less than 1 million. If you hold a bank account with minimum 100,000 to less than 1 million, you are in this category. This is the base of the pyramid. Another segment, millionaires next door, when you have account with value from 1 million to less than 5 million of dollars. The category number 3, mature millionaires, when you hold account from 5 millions but less than 30, and the top, this is ultra high net worth individuals, if you have account with 30 millions or more. So based on this category, the minimum may be 100,000 of dollars. This is the mass or the base of the pyramid. So there is different price for each service provided by the bank based on the ability or the category or the segment of clients. Corporate banking is the same, target very rich, but very rich corporates or firms, not individuals. So, for example, in this case, we talk about large corporations. So, HSBC, for example, classify services or activities with firms into 3 categories based on the turnover. So, if the corporation with turnover up to 2 million, in this case business banking. In commercial banking, when it starts from 2 million to less than 30, but corporate banking greater than 30 million of dollars. Investment banks. Investment banks in this case, we talk about the deal with corporation and other large institution and don't deal with retail customer. No retail customer in the investment bank. So investment bank talk about the securities. We talk about bonds, shares. In this case, if a bank or if there is any issuance of stock or the bonds, in this case talk about investment bank, not deposit or loan banks. So maybe CIB, known as a commercial bank, on the other hand, when we talk about JP Morgan, is known as investment bank because the core business, securities, underwriting, and the other security related business. Islamic banks, in this case, we'll talk about different terms. Maybe we will replace the return instead the interest rate, and maybe the type of projects will be different for any banks. In this case, we talk about around 100 Islamic banks in the world use this model, and HSBC, for example, enter this model for the first time and offering an Islamic mortgage to UK clients to target new or attract new customers for this model. E-banking or electronic banking, in this case we talk about innovation products when we add the information technology with the banking services. So in this case, when we talk about e-money includes reloadable electronic money instruments and in the form of stored value, but remote payments, in this case, we talk about the payment instrument that allow remote access to customers. This is the mapping for e-banking. So e-banking as a part of e-finance and e-finance as a part of e-commerce. E-banking includes internet banking and telephone banking and other electronic. Thank you, my dear students, and see you in the next lecture, and goodbye.